Let's turn focus and get our expert right here on Business Tonight. On the markets, the move, and should you be nervous? Nilesh, MD and CEO of Axis Capital, joins us live here on Business Tonight. Thanks very much, Nilesh, for being with us. The question that we are debating, and purely from investors' point of view, is, are the markets overheated?
I don't think so. Markets can be termed as overheated. Markets are at all-time high, but the valuations are not. Of course, valuations are no longer cheap as they were long before, but certainly valuations are not very, very expensive. And hence it will be unfair to state that markets are overheated at this point of time.
But Nilesh, what kind of correction do you expect, if any, and if not, what sort of an upside is there in these markets?
It's always difficult to predict short-term corrections when clearly markets are going to be volatile. And compared to last year when it was almost 50% lower and valuations were also very, very cheap, compared to that the probability of a correction has increased reasonably high. But that doesn't mean that the nature of this market changes. The nature of market remains buy on dip. India is on a multi-year bull run market. If we see retail participation in equity market, it has picked up since May, but it's still at all-time low level. If we see India vis-a-vis its peers in emerging market, we stand out despite our valuation vis-a-vis other peers. So look at from a global flow as well as local flow point of view, Indian markets have far more flows to receive than probably what it has received till now.
So Nilesh, in a sense, you're saying that, volatility is really going to be the name of the game. But what about potential investors who are a bit, nervous looking at this fast clip with which we are seeing equities literally zoom through the roof? What should their strategy be?
I mean, in a very lighter vein, I can say that they should invest and then become Rip Van Winkle, go and sleep for 10 years. After 10 years, when they'll see the prices, they'll continue to have the same feeling of being unreal then also. So be a Rip Van Winkle after making investment in equity.
Be a Rip Van Winkle. I think that's led us to our next question then. For all of those who are invested, is it a good idea, you think, to continue to sit pretty on all those gains? If not, any sectors you think it's possibly time to cash out on?
Definitely they should focus on their portfolio. If they are overexposed to equity, which is unlikely to be the case, then they can probably do a little bit of profit booking because they are overinvested in equity, not because equity markets are not good for investment. Within portfolios, they can also move a little bit from mid-cap to large cap if they are overexposed to mid-cap. But by and large, the existing investor should actually just go and talk about their experience of investing in a market when it was not fashionable to invest in a market ahead of the bull run, and explain to other fellow investors how they should participate in the market. I mean, clearly the domestic allocation to equity is very, very low, and going forward, equity appears to be far better suited for risk return point of view than other forms of investments like gold, bank deposits, real estate, and other fixed income instrument. So the existing investors should just encourage this word of equity investment to their fellow investors.
Any particular sectors, Nilesh, that you suggest one should stay away from, and which are the must-haves in the portfolio according to you?
So investors ideally should have a core and satellite kind of approach to their portfolio. Core portfolio will comprise of defensive sectors across consumer staples, technology, and pharma. These are the companies where you have more predictable cash flows and hence higher valuation. On the other hand, you also have satellite portfolio across banking and financial services and infrastructure and commodities. These companies have little bit of seasonality or cyclicality in their cash flow, and hence they probably go at a little lower valuation. So one can have an ideal blend of defensives as well as aggressives. One can also cut portfolio between large cap and mid cap, and at current level where mid caps are almost trading at the valuation of large cap, it makes sense to be overweight large cap. The third and the most important factor which one will have to apply to its portfolio is the corporate governance track record of these companies. I mean, clearly it makes sense to invest in companies where the owners, the promoters are willing to share their wealth with the shareholders. So be very, very careful about companies in which you are investing. Go with quality, blue chip, sound management.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.